I'm so excited to introduce you to the best website designers out there. We have a brand new partnership with Session Sites. It is where good therapy meets brilliant design, and they get your website switched over or built in less than 2 weeks. They fine tune your messaging, use science backed user experience methodology, and work exclusively with mental health professionals. In fact, new clients right now are going to get 3 free therapy marketing strategy calls with their creative director of Session Sites if you book today. You're not going to want to miss this. Head on over to sessionsites.com/Joe. Again, that's sessionsites.com/Joe. Get the website of your dreams today. Sessionsites.com/Joe. This is the Practice of the Practice podcast with Joe Sanak, session number 1137. I'm Joe Sanak, your host, and welcome to the Practice of the Practice podcast, where we cover all sorts of things to help you build a thriving private practice you absolutely love. We do this through the lens of just interviewing really interesting people that can be one of the many puzzle pieces that it takes to help you build your private practice. And, tax planning is one of those things. We partner with all sorts of different folks that help with taxes. And I'm so excited today to dive in with Alexis Gallati, who is the founder and lead tax strategist at Cerebral Tax Advisors, Cerebral Wealth Academy, and the author of the book Advanced Tax Planning for Medical Professionals. She has over 20 years of experience in high-level strategic tax planning and multi-state tax prep, and has trained at the highest level, holding 2 master's degrees. Alexis grew up in a family of physicians and is married to a private practice physician. That's why she understands how hard medical professionals work to get where they are, and why she provides simple and accessible tax solutions tailored to busy physicians. Alexis, welcome to the Practice of the Practice podcast.
Thank you so much, Joe. I'm happy to be here.
Yeah, well, you're in a family now of physicians. You were in a family as a kid. What are things that you saw in that world that made you want to help with taxes?
Basically, just how much a big change was going to happen with my husband and I when we were about a year and a half out from him finishing his residency. And so I was just working full time doing local and regional CPA firms, and then I just saw the writing on the wall. We were going to go from this much smaller tax bracket to this much higher tax bracket. And I was like, okay, why are the Warren Buffetts and the Bill Gates of the world, at this like 10, 15% tax bracket, and how can I get there? And so that's when I really dug my heels into finding strategies that would not only help my own family situation, but I was like, just from the circles that we rolled in, so many other physicians were in the exact same position. And, luckily my father, as a private practice physician, he was really great with his finances as well. And so I learned a lot from him, and then being able to put that towards my husband's practice and then my client's practice, and then all these new strategies, because obviously the tax code changes from the 1970s all the way to now. But yeah, it was basically just almost a survival thing for my husband and I that kind of sparked it all.
Yeah, and as people come out of grad school and start to go into private practice, what are some things early stage? So we're talking first 5 years, someone's starting a private practice, that they can do to optimize their tax situation.
Yeah, first thing is just knowing, figuring out which entity is going to be the best for the area that you're in, and how much you're making, et cetera. Some states like Tennessee, where I live, they don't recognize S corporations. And so there's actually very little benefit to an S corporation. But if you're in, other states like California and New York or Illinois, like et cetera, the S corporation is actually a very tax savvy entity. So also too, it just depends on how much you're making, et cetera. So, basically starting with that entity selection is really important. And really probably even more than that, just getting organized, making sure that you are keeping track of your income expenses and all your deductions and everything, just to make sure you're maximizing everything. You know, those are probably the two biggest items, besides getting into more detailed strategies like retirement, or if you have employees or hiring your kids, etc. So start with organizing, because that will obviously keep you on the right path, and then the entity selection would be the first two things I would always advise a client to look at.
Yeah. What are some of those kind of low hanging fruit type of tax things? We can get into more advanced tax strategy. And before we always say this at the end, that we are not your accountant or attorney. We are kind of speaking in regards to information. We say that at the end. We say it throughout. So obviously, talk to your own accountant, talk to your own bookkeeper. We are not your accountant, but we are talking about accounting information. What are some other low hanging fruit for people in most tax situations when they're starting up their counseling practice?
Yeah, low hanging fruit is definitely retirement is probably the easiest deduction out there, and it also helps you continue to build wealth. And the way I always like to put it is you're taking money out of the hands of the IRS, putting it into your retirement, having that grow tax free, and then you're also getting a tax deduction for as well if you do it as on a pre-tax basis. Another thing is if you have children that are of appropriate age, or even uh, family members like parents that you support, hiring them through your practice is a great way to shift income from your higher tax bracket down to their lower tax bracket, or even with a child, a non-existent tax bracket. Um, Also too, I mean, taking advantage of just basic deductions like your office and your home, or writing off your vehicle expenses, even the ever popular TikTok's popular strategy of of the Augusta rule, or 14-day rental rule, renting your home to your business. That's another great way to just essentially, what we're trying to do is move as many personal expenses to being legitimate business deductions.
Will you
Uh,
go into the Augusta rule? I am on TikTok, but I don't think I've heard that yet as to what that is.
oh yeah, so basically this revenue code allows you to write off um, rent. Basically your business rents your personal home, and they are able to take a rental deduction. And then you, as the individual, do not have to pay tax on that rental income as long as the rental period is 14 days or less. And
Mm.
those days don't have to be consecutive. So basically, if you want to do like a once a month board meeting, or you have employee parties, etc., you can get up to that 14 days. It's just that it can't be over 14 days. Otherwise, that income that you receive from your business for that rental income will be um, taxable. So it's really important that you keep it 14 days or less for that one property. So even if you have multiple businesses, um, it's just 14 days for that property amongst the multiple businesses.
Okay, thanks for digging into that. So tell me what other sorts of write-offs. So I kind of interrupted as you were on that string of write-offs. What are some other write-offs that you would say people should be thinking about?
Yeah, so pretty much anything that you have associated with your business. So if you have CME that you have to take, or maybe you're brand new into your practice and you haven't taken your boards yet, the expenses that go towards that. When it comes to the CME, if you travel, like any of the travel expenses for that, your licensing expenses, any equipment that you need to purchase as well. If you're using it within your business, then it's considered ordinary and necessary, then you're able to write that off. So it might be more difficult to write off like, hey, I'm going to go buy a boat, or a new airplane or something and try to write it off through the business. That's a little bit harder of a sell. That could be one of
Mm-hmm.
those things that get you in trouble. But, if you need to go and, even if you go to Staples to buy office supplies and, you know, you're buying it for, just writing in the house and like, hey, I have these pencils or paper or printer paper, et cetera. Like those are all just legitimate, normal business deductions. And so you want to always kind of look at your expenses and say, hey, how can I be using this through my business? Is it considered, again, ordinary, necessary? Those are kind of the magic words with the IRS. And then also to, make sure that you are keeping those itemized receipts and not just uh, keeping track of your, credit card or bank account statements, because those don't count as receipts. You have to have actually the physical itemized receipt.
Mm-hmm. Now, as people start to grow, so they start hiring either 1099 or W-2s as clinicians, so money's coming in, there's more counseling happening that maybe the owner's not doing. Maybe they're even hiring their first virtual assistant or support staff. As people get into hiring, as people, start thinking about that, what should they be thinking about?
Sure. So you need to determine whether or not that employee or a new staff member is, 1099 contractor or a W-2. Um, it's a very big distinctive difference. Essentially, if you're 1099, you are not, or you hire someone that's 1099, you are not controlling how they do that work. It's really important to go look at that criteria to see whether or not, the person does qualify as 1099, because that's kind of the direction you'd want to go. And the main reason for that is because you're not having to pay the employer side of payroll taxes when somebody's 1099. However, and then you also don't have to pay them any sort of benefits as well. So, like if you have a retirement plan for yourself, if they're W-2, then you'll need to include them on your retirement plan once you've gone in, once they're eligible, essentially. So that's a very important distinction. W-2 employees are much more expensive for the employer, but you also have a lot greater control over them as well. And so that's a very important distinction. You'll need to, depending upon your state's rules and then also federal rules, determine what, that person whether or not they qualify as 1099.
Mm-hmm. Now, as people continue to grow their practice, are there other areas that they should be thinking about in regards to just optimizing that tax situation?
Yes. So in terms of, again, organization, that's probably the biggest thing. I know it sounds very basic, but you would not imagine the number of taxpayers that come to me for help, and they they've missed out on so many deductions, or by not going and having things organized properly, like using like a bookkeeping software or even just Excel to keep all of your income and expenses categorized, and also to keep things separate as well, like having a business checking account, having a business credit card. As you grow, you need to start looking at just more advanced strategies around, especially with like retirement. If you have employees, et cetera, like I mentioned before, you have to include those employees. And so you need to account for that additional expense not only as part of being an actual expense, like a deduction, but also too, as part of your employee's overall compensation package. So I find a lot of employers, are scared to, have good retirement plans because they're afraid it's going to cost so much. It does cost, more for you to have that for your employees, but it ends up being a much better situation for you, because one thing, you're able to put away a lot more. And then second, even though you're putting more away for your employees, that's creating loyalty within your employees to stay with you, because usually there's sometimes like a vesting schedule for your employee to actually get access to those retirement funds, depending upon the type of retirement plan you have. And then also too, it's, as I said before, it's part of the compensation package. So like if you start a retirement plan, you might not need to give them as big of a raise the next year because you're putting money towards their retirement and forcing them a little bit to think about their own retirement as well.
Yeah. Something always comes up when you're running a private practice. Well, Gusto's payroll and HR services can make it a little easier. Gusto was designed for you, the small business owner. They take the pain out of running a business, automatically calculating paychecks, filing payroll taxes, setting up open enrollment. Gusto does it all. Want more? Time tracking, health insurance, 401k, onboarding, commuter benefits, offer letters, access to HR experts. You get the idea. With Gusto, you can focus on the joy of running your business. It's super easy to set up and get started. And if you're moving from another provider, Gusto can transfer all the data for you. It's no surprise 99% of businesses said the value they get for Gusto is worth the price. And here's the best part. Because you're a listener, you get 3 months totally free. All you have to do is go to gusto.com/Joe. Again, that's gusto.com/Joe. I'm telling you, you're going to love Gusto. Get started today. So at the time of this, when this podcast goes live, it's towards the end of the year. What are some things that should be on somebody's end of year checklist to talk with their accountant about, to talk with their bookkeeper, maybe even talk with their business partner or their life partner? What are things that envisioning for the next year, and also making the tax season easier, that people should be doing year end?
Mm-hmm. Yeah, some classic strategies for year end is looking at what income and expenses you have coming up. And so, one way to obviously lower your taxable liability is to maybe defer income. Maybe you have some, insurance payments coming, or you have some clients that, owe you some money that, they would normally pay you by the end of the year, but you might say, hey, you know what, can you wait to make that payment until after January 1st? And so then that defers that income into the next year. Same thing too with expenses. You might want to accelerate some expenses. So maybe you have an extra piece of software that you want to purchase, or extra piece of equipment that you can purchase that now, but maybe you even don't take delivery until later in the year, or sorry, the following year. You can still count that as an expense. So that's always a classic way, whether, deferring income or accelerating expenses, for you to maybe discuss that with your partner, or look at your own, finances early on, before the end of the year, so that you can look at that. And then too, like if you haven't officially hired your children, or hired a parent that you support, etc., you can still run a payroll for them for the end of the year for work that they've done for you earlier in the year. And so then that way you're able to take advantage of that strategy. When it comes to like the home office, or your vehicle expenses, you can go back and gather all that information now, even though it's towards the end of the year, and still take those deductions and reimburse yourself through your business for those things you've already taken. So there's nothing in the rule book that says, like, for your vehicle, for example, you can go back in the year and recreate your mileage log. And then going forward, you can use apps like Mile IQ, or even if you use QuickBooks Online, there's a mileage tracker through there. Going forward, you can start automatically tracking your miles. So it makes the process for the following year a lot easier and more organized for yourself. Again, I always, come back to organization and making sure that you have a system in place for capturing all this data, and that you try to make it as automated as possible for yourself. So then that way, you just have to look at it every once in a while, maybe clean it up a little bit. And then, come tax time, you have everything summarized, and it just makes your world so much easier. As well as if the IRS were to ever challenge anything, you have all of your receipts in place. And remember, you don't have to keep paper receipts. You can do digital receipts. I do this for even my own practice, where I just use Google Drive, and I have a folder tree. So it says 2024 receipts, and then I have subfolders for each of the categories, like travel, meals, education, etc. And I'm able to just take a picture, and put it into my Google Drive into the appropriate subfolder. Or if I get a digital receipt through my email, I can just save that into that folder, and then that way it's there. You don't have to think about it again. You can throw away any paper receipts, and again, if the IRS were to challenge you, boom, that information's right there. You can just send them that folder, and it just makes things so much easier and less of a headache going forward.
Mm. Now, a number of our kind of larger practices are looking at buying buildings instead of renting. And so they
Mm-hmm.
realized, okay, so we're putting all this money into rent for a larger practice. We want to expand, we want to grow. Maybe they even want to have part of the building be just like business income, and then they use the other half of the building. When people are stepping into purchasing a building, and I'm actually in this process right now, we're supposed to close next week on a multifamily home that I'm doing some investments in. Walk us through what people should be thinking about when they're, buying a building. And so some things that come to mind is like, should you have a separate LLC for that building? How do you make sure you get good financing for it? Like, what do commercial loans look like? And I know you're not an expert in all these areas, but
Sure.
what should people be thinking through as they're talking to their accountant if they're thinking maybe in the next year or two I want to get a building?
Yeah, definitely. So it's a little bit of a big question. If you're buying like a multifamily residence like you are, that's very different than buying something for your practice. So
Let's
let's
stick with the
say,
for your practice then, because that's the
yeah,
main listeners.
yeah, definitely. So if you're wanting, let's say, we'll keep it simple to start. If you're purchasing a building for yourself and your practice, let's say there's not going to be any other tenants, then that's a really great way for you to be shifting income from your practice to, yes, I do recommend an LLC for any any real estate that you purchase, whether it's for personal use or business use. Going, or I should say personal, I say like rental property, uh, residential property versus commercial. Put it in an LLC. Of course, you can obviously want to discuss with a real estate attorney in your state whether or not it's really necessary, but I really like to have it because it allows you to separate the liability. So if, for example, you have someone that comes into the building and they fall and hurt themselves, well, they can then sue for that LLC, that property, but not necessarily the business or or for any other of your assets, essentially. So definitely recommend that. It's super easy to set up LLCs, and usually there's just like an annual state fee that you have to pay besides the normal setup fee. Now, when it comes to taxes, what you're looking at is you have a building that you can depreciate, which basically means, it's a commercial building. You're looking at about over 40 years. So if you buy $100,000 building, you can depreciate that building over the 40 years. And so any of the expenses that are associated with that building, like the mortgage, real estate taxes, insurance, general maintenance, etc., all those expenses plus the depreciation compound, and you can move money from your business as rent into your real estate LLC, and then put all those other expenses against it. And so, not only are you writing off, this building and all those expenses, but then you also have an appreciating asset as well. So it's a really great way for you to, grow wealth, but then also instead of you paying rent, I mean, it's the same sort of concept as you purchasing your own home. Instead of you paying rent, you're putting equity into this hopefully appreciating asset. When you have tenants, it's the same sort of thing. Hopefully those tenants are covering a good portion of your your mortgage and your real estate and all those other expenses. And then you can even look into other tax strategies like cost segregation studies, which accelerate that that depreciation. So instead of having that $100,000 over 40 years, let's say, of that 100,000, 25,000 is, 5 to 15 year property. So what I mean by that, for example, is like lighting and fixtures is a 5-year property. So of that 100,000, 25,000 is associated with this 5-year property, let's say. And so then you can go and depreciate that 25,000 over 5 years as opposed to the 40 years. So, like I said, it helps accelerate that depreciation. You get those bigger deductions, and then that can help to lower your tax liability.
Yeah. No, I think that as people enter into some of these things, it just points to why we need to have bookkeepers and accountants and attorneys that, at a certain level are helping you make these decisions. When you think about when it makes sense for people to purchase a building versus rent, and of course you need to see the full situation to give full advice, are there rules of thumb as to, when you're spending this percentage of your income in rent, or you're going to be in a certain location for more than 5 or 10 years, that it tends to make sense? Are there any rules of thumb that people can think about in regards to purchasing a building instead of renting?
I don't have any sort of like certain dollar amount or percentage, et cetera, but it really this has to do with cash flow, and whether or not you have the funds to purchase the building. If it is for that area that you're in, is it, talking to a realtor, hey, is this going to appreciate in value? How much is the appreciation year over year? How much, is rent going for? Because when you set yourself up paying your business, paying rent to your building, it has to be for a fair market amount. The IRS isn't going to say, like, if it's normally like $2,000 a month for rent, and you say, hey, I'm going to actually charge myself $10,000, the IRS can come back to that and say, hey, that's not fair rent. Like, you're overcharging yourself, and you're trying to have shenanigans, basically. So you have to kind of look at all of these factors to say, hey, like, am I getting a good tax deduction out of this? Is this building going to be appreciating? Do I have the cash flow to support, not only like at the down payment, but then the monthly payments year after year? And then also too, like you said, how long am I going to be in this area? Is this home? Is we not moving? Like, do I have maybe a spouse that's in a program that, we might be moving in a few years? So you just got to kind of take a look at those things. And also too, when you're purchasing a building, sometimes, I mean, I've had clients where they're like, hey, we purchased the building, but then we have to do a build out as well. Mm-hmm. So like, that's also a big chunk of money. So that goes back to cash flow. So there's definitely many, many variables that go into it. And I would say the major things are obviously the cash flow and the potential appreciation on that property.
Mm. Well, the last question I always ask is, if every private practitioner in the world were listening right now, what would you want them to know?
That you're doing amazing, especially with taxes. It's so confusing. I mean, this is something that I dedicate my life to. But with having growing up in a family of physicians, my husband being a physician, like, I am not science brain based at all. And so I have so much respect for what you guys do. And it's okay that you don't know everything about taxes, and you're not expected to. And luckily there's such great resources out there for you to learn on your own, or, to work with professionals that can help you. And all I just got to say is that you're doing amazing. And the fact that you're listening to this podcast and that you're, just trying to get, even a basic knowledge. So then that way, when you go out there and you look for that help, you've taken a great step in your financial future by just getting that knowledge. And so bravo for you.
Mm. Well, Alexis, if people want to connect with you, how can they find your work and read more?
Yeah, definitely. So going to our website, cerebraltaxadvisors.com, is the best place to kind of learn more about Cerebral. I have links to my book on there. If you just, basically was like a brain dump for me of different tax strategies for you to go through. We go through real estate stuff. We go through the basics. We go through some more advanced as well. So, and feel free to reach out to me as well. This is Alexis at cerebraltaxadvisors.com. And I love just chatting about different tax strategies. And again, bravo to you guys for trying to gain that knowledge.
Well, thank you so much for being on the Practice of the Practice podcast.
Thank you so much, Joe. It's great. I appreciate it.
Well, yeah, now it's the end of the year, final stretch. Just time to think through all of these things, walking through kind of checklists and looking at your tax strategy. I remember my very first year when I met with an accountant. I had used, one of those kind of home and business kind of things where you do it yourself. And the first year, my accountant, and this is someone who I don't use anymore, but told me about an S Corp, what we had talked about. And in Michigan, that's totally fine to do, file as an S Corp. In the first year, I think it was like $10,000 in tax savings that I was going to save that I missed out on because I had been operating at a certain level that it made sense, and totally missed out on all these savings. So figure out your tax situation, talk to a good accountant, and we couldn't do this without our sponsors. And if you're looking for some help when it comes to your payroll, when it comes to health insurance, 401k, onboarding, commuter benefits, offer letters, HR experts, all of that stuff that you need to run your business, Gusto is the service for you. It's who we use here, and it's totally worth the price. The best part is because you're a listener, you get 3 months totally for free. All you have to do is go to gusto.com/Joe. Again, that's gusto, gusto.com/Joe. And I'm telling you, you are going to love it. Get started today. Thank you for letting me into your ears and into your brain. Have a great day. I'll talk to you soon. Special thanks to the band Silence is Sexy for that intro music, and this podcast is designed to provide accurate and authoritative information in regard to the subject matter covered. It is given with the understanding that neither the host, the producers, the publishers, or guests are rendering legal, accounting, clinical, or other professional information. If you want a professional, you should find one.